Today's session is happening in Q4, obviously, but it is, I look back over Q3. So in this session today, we will be covering the following things on the agenda. I do need to run at 4:45, so we've got 42 minutes left in the session, and I'll try to get through it so that we have 5 to 10 minutes of Q&A towards the end, where I will answer your questions. So in the session today, I'll talk about my background and my investment journey, my investment strategy and my lifetime goal, the key events that happened and drove the experience that we had in Q3, the performance review of my portfolio and the market broadly, the winners and losers, any portfolio changes that I have made, and then looking forward into what I think is likely to happen through Q4, but also Q4 2022 and Q1 2023, so the next, let's say, 6 months, and then my closing remarks. All right, in terms of my background, so I am South African by birth, but I've lived in the UK for quite a long time now, 14 years. I have 20 years of experience as a consultant and later a person that ran and started businesses. So I've been working as a consultant across the entire spectrum of initially technology from a very young age. So my way of making money when I was a teenager was helping people with their computers. And then later on, once I became more senior, working as a management consultant, strategy consultant, in quite a few different types of businesses. So some of them were startups, but some of them were enormous companies. For example, I've spent years as a consultant working in Unilever and within that kind of industry, delivering some very, very large projects across the entire world at a time, massive projects worth north of $100 million. I'm a published author and speaker, public speaker. So the only book that I published is a book about technology. It was the first book about Salesforce technology that was published, and I've had many blogs over my lifetime about different topics. I've published millions and millions of words, and I've spoken at many events around the world on different topics. I'm now a full-time Etoro popular investor, although I do also advise a number of companies. I guess it's kind of a consulting role, an executive consulting role, and some of those companies that I invest in, so private companies. A few things about me, a few facts about me. So I'm 41 years old, about to be 42 at the end of this month. I made my first investment in '95, but it wasn't in the stock market, at least not directly. It was a unit trust in South Africa. I didn't know what it meant at the time, but that's how things started. And I have had adult braces twice. I didn't wear my retainer the second time, so I had to do it again. In terms of my journey as a stock investor, so still in South Africa, 19 years old, during 1999. And I had just finished school. I was working my first job, and I learned about the stock market via my unit trusts. Thought it was a way to get rich quickly. Saw that lots of South African technology companies had run up fantastically in their share price and got into the market probably 2 weeks before the collapse of the entire thing. So that was the first time that I burnt my fingers in the stock market. Luckily, I didn't have very much money, so I couldn't lose very much. But as a percentage of everything I owned, it was quite a lot. I was self-educated when it comes to stock investment initially, although I did have a number of mentors, not necessarily people that were investors themselves, at least not as their primary jobs, but I had a knack for befriending executives in various companies, and they taught me a lot about the way that companies run and the people, what to look for in good management teams, strategies within those businesses. And that's the basis, a good basis for investing in as a long-term investor. Maybe not so much as a trader, but definitely as someone that's looking to invest in companies. I joined Etoro in 2015, so I've been on the platform for 7 years now. and I became a popular investor in 2016. Outside of eToro, I do have I had more of a portfolio of properties. I've been selling those down through this year because I had a feeling interest rates would run quite high. So I actually just have one more that I need to sell. I'm an angel investor, so there are companies all the way from very tiny companies through to larger businesses that I have invested in. I've been invested in crypto outside of eToro almost since the beginning of Bitcoin, even having a mining rig at one point, 3 GPUs sitting in my lounge, mining Bitcoin and Dogecoin a long, long time ago. And as I mentioned already, I advise a few businesses. When I talk about my investment strategy, I like to talk about it in terms of these 4 pillars that you see on screen. So there's my style, the way that I do analysis, the way that I implement my strategy, and then the things that I expect from my investments. And I think that for a lot of newer investors, the expectation can be quite off initially. So they get into investing with one set of expectations, maybe not having been taught that expectations are incredibly important. There are lots of ways to make money in the stock market. There are some common threads amongst those different ways, but you need to have the right expectation when it comes to investing. So for example, expecting that you're going to make a 50% return in the middle of a long-wearing bear market is not a good expectation. But if you're young, you might not know that, right? Or if you're inexperienced when it comes to investing, you might not know that. On eToro, if you copy multiple people, you probably should have different expectations for them based on the different strategies they have. So some might be low volatility, low return, and others might be high volatility, hoping for a higher return. But I do see people that copy different people, expecting the same thing from all of them. In terms of my investment style, so I push this messaging week in, week out. I am a long-term investor. Over my 22 odd years of investing in the stock market, I've tried many different ways. I've tried to skin this cat in many different ways. And I've found that long-term investing in good quality businesses tends to be the least stressful and have the best outcome. I would argue that given the wealthiest investors in the world also invest this way, that demonstrates the success or the potential success of this strategy too. I have a business owner mindset. So I think when I was younger, I didn't have as much of a business owner mindset when investing in stocks. It was more, I would say it was more gambling. So when I was, in my early 20s, I was trying to get rich fairly quickly. But I found over time, becoming senior in businesses, running businesses, having a business owner mindset before investing in that company is very important. So when I buy a share in a company, I want to make sure that that business is going to be successful. You can't know that for certain, but you want to know that the right people in place, the right strategy, the right amount of money, the right timing. There's always a bit of luck in there, though. I invest using the principle of growth at a reasonable price when required. So when a bull run has been going for 4 years or 5 years, and the macro conditions still support that bull run, it might be that that the market is more expensive than it was at the bottom of the bear market. And so in order to find the least risky investments, you need to find good companies. They're not necessarily going to be cheap, but the price will be reasonable given the amount of growth they have. I tend to prefer profitable growth companies over companies that are just growing and don't have any profitability on the horizon. My focus is usually the USA, and that's for a few reasons. It's the largest stock market in the world. They also tend to invest well in themselves. And obviously some of the largest and most successful companies in the world are in the USA. And I expect volatility from my particular investment style. In terms of my analysis, I'm going to go a little faster, otherwise I'm going to run out of time. I'm a bottoms up investor, so my highest priority is understanding the details of the company that I'm investing in. So I need to understand its model, its competitors, the leadership team, the product pipeline, the industry that it's in order to understand the quality of that business. Is it worth an investment? I almost always prefer companies that are in growing industries. And these days, those tend to be technology companies, but they aren't always. So one example is I expect the copper industry to be quite a big growth industry through the next decade, maybe slightly more than that. And that's due to the electrification of the world, not just electric cars, but there are lots of parts of the world that don't yet have electric cables running through their villages and towns, etc. And that's changing quite rapidly as the world industrializes. As any of you that watch my weekly videos know, so I understand a lot about macroeconomics, but it isn't a very high priority. It's a lower priority than me in terms of my analysis than the bottoms up analysis of those particular companies. It's good to understand the context in which these companies are operating. It's good to understand why the hell is the world doing and the stock market doing what it's doing right now. A little bit for your own sanity. And it obviously is an influence to the things that I analyze for investment, but it isn't the be all and end all. Politics obviously has some part to play. If there's a big bill coming through that is going to invest in semiconductors in the US, that obviously can have a big effect on the fundamentals of a business and its sector. And technical analysis is also something that I use. So I think that a lot of investors, they start in the TA kind of area, trying to figure out how they can make money off of the patterns that you see on screen. And they find that it's very difficult to be consistently successful. However, I formalized my knowledge in this area quite a lot, because once you have a better understanding of the stock market overall, it becomes very easy to read, looking backwards at least, the psychology of the stock market. So the most basic technical analysis measures, I think, are very good at giving you perspective when it comes to the way that the market feels about whatever it is that you're looking at on screen. In terms of my strategy implementation, so almost everything I invest in is for many months or even years. 10% of what I invest in is for momentum trades. Those aren't really investments. So this might be a setup where there's a breakout on a particular stock, and I think that it might continue, the price action might continue in that particular direction. So a recent example of this would be Netflix, right? So last night's fantastic earnings, massive breakout from where they are. But actually the rest of the setup pattern isn't there. And because of the macro conditions, I don't see that as a good momentum trade. I think that could break down quite easily in the short term, although I think Netflix will be fine in the long term. And 10% of my investments or my trades are just other things that don't fall into those other buckets. I tend to build my positions over time. You never know when a stock or a market is going to bottom. And so I will add and grow a position based on the amount of risk that I think there is that particular position might fall further. So it might be that I buy something that I think is cheap and it falls another 25%. That doesn't mean that it wasn't cheap when it was further up. It just means that I have an opportunity to add to that position at a better price. I don't use leverage very often. There's a cost to it, but also it amplifies volatility, and my portfolio tends to be quite volatile on its own because I concentrate my investments in particular sectors. And I do hedge from time to time, but hedges are there not necessarily to make you money, and there's almost always a cost involved to hedges. So if you're able to read about the statistics around hedges that have been studied publicly through the world, it's typical for hedges to fail 66 or 63% of the time. So 2/3 of the time, hedges lose money, and they're really there to protect the value of a portfolio for that other third of a time. But there is a cost. There's always a cost. And then in terms of my investment expectation, and this took me a long time to learn about my own strategy, probably 5 to 7 years into my investment strategy is that I expect higher returns than the market in the bull markets, in the bull phases, but I also typically see bigger drawdowns than the market when the market falls. Now, that might sound counterintuitive, but the fact is that the bull markets, on average, are 4 times the length and 4 times the size of bear markets. So as long as you're not losing enormously to the market in the downturns, and you're beating the market by more or the same amount in the bull runs, because of the length and size of those bull runs, you end up outperforming enormously. So there is a cost to superior performance in the market over the long term. And the 2 charts that I have up on screen, I wanted to show a simplified example of this. So the bottom charts, the bottom candles are the S&P 500 running from about, let's say, 2016 until present day. So if you had invested in the S&P 500 for that period, you would have made an 82% return, which is good. It's better than leaving it in the bank, that's for sure. However, if you had invested in a basket of big technology companies, the journey will have been a lot more bumpy, right? The volatility is completely obvious from this chart, and you can see the collapse of the collective share price of this particular ETF through the last year. But despite that, it's still enormously outperforming the S&P 500. And this is a good summary for my approach to when it comes to investment. In terms of my lifetime goal, so I would like to have 20 years with a compound annual growth rate of 25%. Now, this is a very ambitious goal. And I think on Etoro, so my 7 or so year CAGR on Etoro is about 22, 23%. And what that means is that for the next few years beyond this bear market, I need to exceed 25% per year in order to bring that up. I know when I tell people this, a lot of people laugh, saying this is not a reasonable expectation, but there are people that have done it. And I think that the reason there are so few examples of people having done this historically is because of how inaccessible investing used to be, and also because there wasn't a publicly available track record for anyone to go and check it out. Obviously, this becomes very difficult if you do this. You're probably going to end up with, depending on how much money you start with, you could end up with billions of dollars invested, and then it becomes a lot more difficult because of the mechanics of the market. But for now, this remains my goal. All right. In terms of the Q3 headline topics, again, this is the stuff that happened running from July, beginning of July or end of June, through to the end of September. On screen in the top chart, I have the NASDAQ 100. In the bottom screen, I have the S&P 500. Through the past quarter, we saw that incredible bear market rally. It happened in typical fashion. It was very quick. We saw the most beaten down stocks rise by the most, and subsequently it just collapsed. So the NASDAQ, from the beginning of the quarter to the height of that rally, was up 19%. The S&P 500 up nearly 14%. But by the end of the quarter, they were both down a little bit. So S&P down, I'm not sure if you can read this on screen, so I'll read them for you. The NASDAQ was down by less than the S&P 500 at 4.5%, and the S&P 500 down by 5.2%. Now, this is very volatile and was unpleasant to experience, but it is also a lot less bad than the previous quarter, Q2. And I'll talk about market structure in a moment. I'll throw up a diagram on screen. But this is fairly typical unless the world falls into a very deep recession, unless the US falls into a very deep recession. I expect that the market is doing something called base building. So the biggest, sharpest declines are probably behind us. There might be a few to come, but now the market is, kind of moving in a sideways fashion, and will continue to do that until the macro situation changes, and confidence returns to the market. And you no longer see those headlines about, are we in a bear market? Aren't we in a bear market? I think it's just accepted now. We're in a bear market. We've been in a bear market for a while. I think that different people have different ideas about when it started. Some people will say it's from the point at which the S&P 500 dropped below the 20% minus 20% point for the first time. But I think that it probably started early 2021, maybe Q2, beginning of Q2. A few of the other headline topics. So it seems as though inflation in the US is peaking, barring any other huge surprises in the world. The trend, the year-on-year inflation has more or less been flat. In fact, decreasing slightly through the past 7 months. Unfortunately, that's not the case everywhere, but in the US that's the case, and the world at the moment is looking to the US. I think that a lot of people don't realize that the inflation numbers that are put out to the public are rate of change measures. They're annual rate of change measures. So if you bought a pint of milk for £1 in 2020 and it costs you £1.10 in 2021, that's 10% inflation. However, if in 2022 that milk is now £1.11, so it's gone up 1 pence from a year before, the inflation year on year is less than 1%, whereas the inflation the year before that was 10%. So even though the prices in 2022 are 11 pence higher than in 2020, the rate of inflation has, just about stopped. And I think that because of what's happening with inflation at the moment, we're still getting relatively high reads of year-on-year inflation. But in a few months, I think we're going to see those inflation numbers fall off a cliff. So probably starting somewhere towards the beginning of next year, we will see some very sharp declines in the level of inflation, unless, as I said, something crazy happens and the price of oil goes up to like $200. Obviously, there's an energy crisis. I don't think this is news to anyone. So prices are up in many places. In parts of Europe, prices are up several 100%. It took some time for leaders to deal with this, but I think that the response in Europe has been pretty good. Anything else to improve the situation is going to take medium-term and long-term solutions. But I think a lot of what they've done in the short term has been fairly good. The problem is that it's the actions that they've taken, which I think are necessary to save lives, will keep inflation a little bit higher for longer. The war in Ukraine, it drags on, and I mean, I'm not a specialist in war or in these types of politics, but it doesn't look as though we're close to an end. I don't know what would suddenly bring this war to an end. But right now, I think there's a lot of ego involved, a lot of politics being played. So I think this is just something that we might have to live with for a while longer. The dollar continues to be very strong, and that creates all kinds of problems. In my weekly videos, I talk about this quite a lot. I do think this will moderate fairly soon, and I'll talk about that a little bit later. Some reasons that the strong dollar creates problems. It's good for the US in some ways. It helps with the level of inflation in the US, because if they're importing things, those things become cheaper because the dollar is more expensive. But it creates havoc for many countries outside of the US, countries that are buying things denoted in dollars, energy, goods, services. It also means that inflation in those places ticks up because now they're paying in dollars, and lots of governments outside of the US have debt that's denominated in dollars. So if you had, for example, to pay 10% on dollar-denominated debt, and then the dollar rises by another 10 or 15% against your currency, then that 10% is no longer 10%. The cost of servicing that debt has increased too. The various yield curves in the US have inverted, and these are very good indicators of a coming recession. I don't think anyone would be surprised if we see a recession in the US next year, but the yield curves, not only have they inverted, they've inverted significantly, and they've held the degree to which they're inverted for quite a long time now. Jobs data is one thing that the US Fed is waiting to. They really want this to turn. They want to see some weakness within the employment numbers coming out of the US, but employment continues to be quite strong, which is surprising for a number of reasons. The reason that the Fed is looking at this is because wage inflation, so people's wages going up so that they can afford to live in an environment where the price of everything else is rising, is quite sticky, and it has the capacity to keep inflation high, which would then have the capacity to keep rates high. Prices, this is linked to inflation, but prices have fallen in a number of areas. Some prices remain elevated. But if you were to look, for example, at the cost of shipping a container around the world, or buying lumber or buying copper, those prices have fallen dramatically. Even the price of natural gas, given the response of Europeans to the energy crisis, has fallen significantly. So, for example, lumber is down, when I last checked, something like 66% from the high that it reached in 2021. And the layoffs continue, which is a bit confounding because the jobs data is still quite strong, but there are lots of companies that have been tightening their belts. And so some are freezing hires, whereas others are laying off employees. I think it's been very difficult to run a company over the past 2 or 3 years. I mean, imagine, for example, that you were Shopify and you saw this enormous boom in demand for your product, and you had to hire people in order to effectively service that demand, to deliver a good quality product. And then suddenly that demand reverses enormously, and you just have to let go of huge amounts of people again. So psychologically difficult for people running those businesses, the employees of those businesses, and just makes for a very difficult operating environment. I have spoken about this chart on my weekly videos before so I'm just doing a time check. The reason that I wanted to show it now, so this is something that you probably would look at more if you were a technical trader. So if you were trading and not investing. However, I think it's good to understand various perspectives on the market. I think having many tools in your tool belt can't do any harm. It can only help you. And the reason I think this is valuable is because it's a pretty obvious map of the journey that people take, investors take, traders take through the market in terms of price action. And we are most certainly in the far right on the decline side of this. I'm not sure if you can read all of the text. I think it might be a little bit too small, and I'm sorry about that, but I wanted to fit the whole thing on screen. But if you Google for it, you should be able to find this yourself. And right now, according to this chart, we are probably in 4-3. So the far right of this diagram, and I tend to agree. And so this is called the late decline. The description here, I'll read this one out. The downward momentum is still present, and declines can come rapidly, but so too can violent, short squeeze rallies, particularly after bad news is reported. And we have an example of this. So was it last week, the CPI data, inflation data out of the US came in a little hotter than the market was expecting, and the market opened and there was an enormous dump. Everything dropped. And then within a few hours, it had reversed and there was a crazy rally, which hints at the fact that there's been some kind of violent short squeeze rally in the market. So we have many stocks and indices below their long-term moving averages, which is also mentioned somewhere in this diagram. And I think that the bulk of the stock market is somewhere in 4-3, but there are some companies that are entering the far left side, this 1-1. So there are companies whose share price action is dancing around the long-term moving averages, the 200-day moving average, the 100-day moving average, because not all companies exit bear markets at the same time. You find that the leaders of the next bull markets typically bottom before the rest of the markets, and also rise before the rest of the market. Right, in terms of performance stats, so for the period running from the first day of July to the last day of September, my portfolio had a loss of 5.1%, NASDAQ 4.5%, S&P 500 5.2%, and the Russell 2000, so 2,000 smallish listed companies, minus 3%. So a rough quarter, but nowhere near as rough as the quarter that was before that. The numbers that are most important to me are the ones along the bottom. And so for me, this is my Etoro lifetime performance. So from the time that I joined Etoro in March 2015 until present. Is it until present? This might be until last month, actually, because I don't have the number until present. So my return is 300% in that period, 150 for the NASDAQ 100, 70% for the S&P 500, and 35% for the Russell 2000. All right. In terms of Q3 winners and losers, there's not much to say here because it can be summarized very easily. The dollar and US bond yields are some of the very few winners from the last quarter, creating all kinds of havoc. Oil and natural gas prices, I think they've rallied in the past since the end of last quarter, so through this month, but they were more or less flat through the last quarter, which helps a bit with inflation, and just about everything else has been in the red. There are some emerging markets that actually have done okay, but I don't want to throw too much detail into this particular slide. In terms of portfolio changes, and I need to speed up, so the structure of this slide is things that I bought and things that I sold within the quarter. So long-term things that I bought, momentum, things that I bought, hedges that I bought. In terms of long-term things that I bought, I swapped my Alibaba positions, the US listed Alibaba positions for Hong Kong listed positions, just because there was a risk of being delisted in the US. It seems that some of that risk has been mitigated at the moment, although I haven't seen news about it recently, because US auditors have flown to Hong Kong to begin the process of auditing, which would hopefully ensure that these companies aren't delisted, but we'll see. I also bought some Shopify. It's still a fantastic company. The share price is down, I think, 80 to 83% from its high. It's a well-run company. It was doing well before the pandemic. Obviously, it exploded in growth during the pandemic, and I believe the sell-in has been enormously overdone there. I think it's a fantastic time to buy that for the long term. Twilio, I'm going to jump one down. So Twilio, I think, Twilio is a fantastic company. The technology is incredible. I've worked with the technology for a long, long time, at least a decade. The company has had some trouble becoming profitable, and that's why the market has been punishing them for a long time. I think they're also down close to 85% from their all-time high. But profitability is just on the horizon. They're very close to achieving profitability now. If that picture were to change, I wouldn't add any more to that position. It's a small position at the moment. But I think that they're close, and I think that they're a leader within their particular area. So Freeport-McMoRan is a company that I've been watching for a while. I've also bought a little bit there, and that's more or less me investing in the fact that I think that copper is going to be a growth industry for the next decade and a half, at least. The share price there is also down quite a lot, which is unusual for this type of company. So I took advantage of that. In terms of things I sold Canadian Solar because not entirely. I sold part of my position just because it had a fantastic run and the market conditions I don't think support extended bullish runs at the moment. I sold out some of Digital Turbine and Mercado Libre, partially because my risk score on Etoro was getting dangerously high, but also because there were other areas that I could invest those positions that would diversify my investments a little bit, and I think were as good places to put that cash. And Cineworld, admittedly, this was a mistake. I should have sold out Cineworld when the court case against Cineworld by, I think, Cineplex, the Canadian company, emerged much earlier this year. So Cineworld has announced that they are going through a bankruptcy proceeding in the US. That is very scary for a company that holds this much debt. And also the court case with the Canadian company has gone against them, and they should owe that company, I think it's more than $1 billion, multiples of their market cap. What typically happens in a bankruptcy proceeding like this is that companies come in, and if they think financiers come in, and if they think the company's worth salvaging, they will restructure the debt of their company, and they'll probably lend it some money. They will lend it that money in exchange for an enormous chunk of their company, probably in this case, all of the company. And so even from today's share price, I think that current investors could lose just about everything if that happens. It's just too risky. It became too risky a long time ago, and I should have sold out of it, even if it was at quite a large loss. So I left that too late. I won't be doing that again. In terms of momentum trades, so I'm never sure how to pronounce this company's name. It's not Vale, I think it's Vale. Vale and Rio Tinto, these were momentum trades on the fact that metals, so for example, copper, the price of copper had been absolutely blasted, I think towards the beginning of last quarter, and they were obviously too cheap. When these companies started rising again, I took advantage of the momentum within those companies and sold out of those. And then in terms of hedges, so I've had hedges on the NASDAQ and S&P 500 at various points through the last quarter. Unfortunately, some of my NASDAQ shorts, they hit their stop losses as the market turned and then dropped enormously, giving back all of the gains in that market. So I had a lot of shorts that were profitable in small amounts of profits, and then I had some that were losses, chunky losses, and I don't think they're entirely balanced out. I think that overall I had a slight loss when it comes to the shorts, just trying to balance out the portfolio, the volatility in my portfolio. All right, and I'm going to go through this very fast. So looking forward, I think that through the next 6 months, we're likely to see inflation in the US continuing to decline. The caveat being, oil doesn't go to $100. I think Europe is still looking to find its peak, but probably finds the peak in that same time period. Earnings are very important at the moment. We have the bond market guessing at what the economy is going to be doing 2, 5, 10, 20 years out. But this is another data point. In aggregate, having hundreds or thousands of companies say that we think over the next 12 months, we are going to be making, our earnings are going to grow by X, or they're going to decline by X, is a very good data point. It's a bottom-up data point on how the economy is going to do. The stock market at the moment is pricing in a bit of a recession, but not a very deep recession. So if earnings tell us that a deep recession is coming, then the market could fall further. So recessions, I think that some countries are in recessions already, and others will fall into them through the coming 6 months. I don't think that's a surprise to anyone. Rate hikes, I think we'll see the last of the very large rate hikes through the next 6 months. And the bond markets in Europe, the UK, the US are signaling that the people that invest in bonds more or less agree with this. It doesn't mean that they're definitely right, and it doesn't mean that rate hikes will end in the next 6 months, just that the biggest ones land towards the end of this year, potentially the beginning of next year. In the US, I think that we'll see the last big ones through this year, and then it'll be tapering off early next year. The question then becomes, are we nearing the bottom of the bear market? Do we see the bottom somewhere in the next 3 to 6 months? If rates, which are the primary direct driver of share prices right now, they peak somewhere in the next, maybe not 3 to 6 months, but 6 to 12 months, will the bear market find a bottom, given that the stock market is forward-looking? So the stock market is usually trying to figure out where the macroeconomic situation will be, let's say 6 to 12 months from now. And so I really think that I think that there might be one more decline, and at best the market travel sideways for the rest of the year. And China is stuck. I don't see any way out of their current situation. They didn't release their GDP numbers recently. COVID zero is just killing them. No matter what they do to try and stimulate the economy, I don't see how they get out of the situation that they're in. They can't run a country effectively. They can't create demand effectively. They can't build consumer confidence and confidence in their real estate market if they carry on shutting down some of their biggest markets. We also have the US midterms, which I think are on the 8th of November, early November at least. And statistically, there have only been 2 years, I think in the past 100, where there wasn't a rally into the midterms. But this year, and the situation that we're in is quite special, so I don't think it's guaranteed. One way or the other, I think we're going to see some volatility. And if these other things play out, so if the world settles down a little bit, if we see a peak in inflation and we start thinking that we're going to see a peak in interest rates at some point next year, then the dollar should start to weaken, especially since the US economy will likely continue to slow down and people outside the US will buy less stuff from the US, creating less demand and probably weakening the dollar a bit. I think this is okay, so second to last slide. So to me, the biggest risk for an investor is impatience. You have to do the hard work. You need to find the companies. I spend at least 58 hours a week reading things, creating various models around the businesses that I own or I want to own to understand them better. But sometimes I think that ultimately impatience is the thing that gets most investors. So to summarize what I have on screen, and it's a theme that I've been talking to, I guess, this entire presentation. Along the top, we have the S&P 500 running back to about 2007. And in this case, you can see that you make a return of 141% on the far right from the S&P 500 if you'd bought and held. And the line looks relatively smooth, right? Living that line might not have felt that it might not have felt very smooth, but in comparison to the very colorful lines below that, the volatility of the S&P 500 is very low. However, if you had bought a basket of these companies, I think that 2 or 3 of them underperform the S&P 500, but the rest of them enormously outperform the S&P 500. Then over the lifetime of this investment, your collective investments would have outperformed that 141% by a large margin. So I don't know if I'm flogging a dead horse here, but volatility is ugly, difficult thing to deal with and be patient with, but it is worth it in the end if you do the work and you're able to be patient. All right, so closing remarks. This bear market is record-setting in a number of ways. I don't know how many of you know. So it's the fourth worst performance for the bond market, US bond market, in over 300 years. It's been rough all over. It's not just stocks. It's also the bond investors. It's one out of a lot of investors. Lots of people have exited the market. I don't know if you've seen the recent earnings reports out of the major investment banks in the US that have been coming out through the past 2 weeks. But revenues are massively down in this particular area. Investors have left. The appetite for investment is just not there. But this is the right time. Now is the time to actually be the most excited about being invested in the stock market. To be successful, as an investor, you need to be very patient, but you also need a stomach for volatility. And sometimes you need to go through a cycle, at least, to develop that iron stomach, that iron will. I do think that we are cresting. Maybe we're not past the worst of the macro situation, but we're close. We're somewhere there. But that doesn't mean that it's days away or weeks away. It's probably 1 to 3 quarters away. But again, the stock market is forward-looking. We need to bear that in mind. And on average, the stock market bottoms 6 months before the economy. So just bear that in mind. By the time that the average Joe starts feeling better about the situation and the economy, the stock market has already moved on. And the average 12-month return for stocks from the bottom of a bear market is over 40%. And that's just the average. So if you have companies that are better than the average, then you're likely to do even better than that. And then on the right, I just have a little diagram that I had in the last presentation too. So the average number of bull market years in the last 92 years was about 80%. So 4 out of 5 years are bull market years. The average loss in a bear market is 36%. And the average gain in a bull market is 114%. So as long as you are in the market through that entire period and not doing crazy things like overtrading and choosing baskets of only of companies that go bankrupt, you're likely to do pretty well. And lastly, just the bottom there, the reason I have this up here is because the NASDAQ 100 is a lot more volatile than the S&P 500. It's got fewer companies, so you'd expect it to be more volatile. But the return eclipses the S&P 500 enormously.